If you don't understand market structure, you don't understand the market. It's the foundation behind every chart, every trend, and every trading opportunity. But here's the problem. Most traders jump into buying and selling without even knowing who's in control or why price is moving the way it is. In this video, I'm going to break down market structure in the clearest and most practical way possible. You'll learn the 3 market types every trader must know, how to spot impulsive moves and pullbacks, how to predict the end of a trend before others see it, and how to avoid smart money traps inside sideways markets. If that sounds like the kind of trading knowledge you've been looking for, make sure to like this video and subscribe to the channel. It helps the algorithm and it helps you never miss a strategy that could change the way you trade forever. Before we start, just a quick disclaimer. This video is for educational purposes only and does not constitute financial advice. Trading involves risks and you should never invest more than you can afford to lose. Always do your own research or speak to a licensed financial advisor before making any trading decisions. Let's get started. There are 3 main types of markets you'll encounter: uptrend, downtrend, and range-bound markets. Let's start with the uptrend. In an uptrending market, buyers are in control. This means price is making higher highs and higher lows. So when the market is trending upward, your mindset should shift toward buying opportunities, not selling. You want to trade in the direction of strength. Now let's talk about the downtrend. In a downtrending market, sellers are in control. Price is making lower highs and lower lows. This is not the time to buy blindly. Focus instead on finding selling opportunities in the direction of the dominant force. And then there's the range-bound market, also known as consolidation. This is when buyers and sellers are in balance. Price moves sideways within a clear support and resistance zone. No one is clearly in control, so the best trades happen when one side finally takes control, either buyers pushing the price up or sellers pushing it down. We'll cover how to spot these moments in detail, so make sure you don't skip any part of this video. Now, as we said earlier, when the market is in an uptrend, your job is to look for buying opportunities. But the question is, how do you find the right time to buy? To answer that, you need to understand what we call the fundamental trend pattern. An uptrend is made up of 2 key components. Impulsive moves. These are strong, directional moves upward, showing that buyers are aggressively pushing the market. Why do impulsive moves form? Because smart money, institutional buyers, step in and drive price higher. But once price reaches a certain point and buyers feel it's too high, many of them take profit. This causes momentum to pause and the market temporarily pulls back. Pullbacks. A pullback is a temporary drop in price after an impulsive move. It's not a trend reversal, it's just the market cooling off. Eventually, when price pulls back to a level that buyers find attractive again, they step back in and trigger a new impulsive move upward. So here's how a professional trader thinks in an uptrend. You want to enter during the pullback before the next impulsive move starts. You avoid chasing the market during impulsive legs. You wait for the market to come to you, then you ride the next wave up. So now you understand how a professional trader thinks during an uptrend. But here's the big question. How do you know exactly when to enter during an uptrend? Not too early, not too late. You want to catch the move right at the end of the pullback, just before the next impulsive leg begins. That's exactly what I'm going to show you in detail in this video, step by step. So don't skip any part, because even one missed detail could cost you a winning trade. Now let's flip the script and talk about the downtrend. In a downtrend, sellers are in control and the market is forming lower highs and lower lows. Just like in an uptrend, we have impulsive moves. These are strong, bearish pushes where sellers aggressively dump positions, driving prices lower. When the market gets too low temporarily, some sellers take profit and short-term buyers step in. This creates the next phase, pullbacks. These are temporary upward corrections inside the downtrend, but smart traders know better. They wait for the pullback to end and then enter a sell trade when the downtrend resumes. Important note, don't get fooled by the pullback. It's not a trend change. It's a setup for your next sell opportunity. Let me now show you exactly how to time your entry in an uptrend using one of the most powerful and reliable principles in market structure, the support and resistance flip. Here's what typically happens. The market is moving upward, creating an impulsive move that breaks above a resistance level. This resistance is a price zone where sellers previously stepped in, causing price to pause or reverse. But this time, buyers break through that resistance with strength. Once that happens, something important changes. That old resistance level now becomes a reference point, a zone we watch closely. Why? Because when price pulls back after that impulsive move, it often returns to retest that same level. And here's the key. If that level holds, meaning price rejects it and bounces upward, it confirms that the pullback has ended and a new impulsive move is beginning. That's your signal. That's where professional traders enter. So let's break it down again. Price breaks above a resistance level, forming an impulsive move. That level now becomes your reference zone. Price pulls back and retests it, and if it holds, it becomes new support. A bullish rejection from this zone? That's the end of the pullback and the start of the next impulsive move. This simple structure happens over and over again in uptrending markets, and it's one of the safest and cleanest ways to enter a trade. In a downtrend, it's the exact same concept but in reverse. Here's how it works. The market is trending down. At some point, price reaches a support level, a zone where buyers previously stepped in, sellers break below it, forming a strong, impulsive move downward. Now, that support level is broken, it becomes our new reference zone, but this time as resistance. Price pulls back, and where does it go? Right back to that broken support level. And now, instead of holding as support, it rejects price from above. That rejection is your signal that the pullback is over and the downtrend is resuming. That's your opportunity to enter a sell trade right at the beginning of the next impulsive leg. Now, here's something most beginners overlook. Even when a market is trending, it doesn't always move in the same way. Earlier, we saw a trending market that respected horizontal support and resistance levels. Let me remind you what that looks like. In an uptrend, price breaks a resistance level, then pulls back to that same level, which now acts as support. Each time price returns to that zone, it gets rejected and forms a new impulsive move upward. This is what we call a support and resistance-based trending market. The same concept applies in a downtrend, just flipped. Price breaks support, pulls back, retests it as resistance, and then continues lower. Now let's look at another type, trendline-based trending market. Take a look at this chart. It's clearly in an uptrend, price is making higher highs and higher lows, but something feels different. You might try to draw horizontal resistance and support levels, but this time, price isn't respecting them. It breaks above them, but doesn't come back to retest those zones cleanly. So what's happening? This is a trendline-based uptrend. Instead of respecting horizontal levels, the market is respecting a diagonal trend line. If you draw a trend line connecting the higher lows, you'll notice something powerful. Every time price touches the trend line, it gets rejected upward, forming a new impulsive move. That trend line acts like dynamic support, guiding the entire move. If you can learn how to identify and draw this trend line correctly, you can predict with high accuracy where the pullback will end and where the next impulsive move will begin. Let's look at this example closely. Price is in an uptrend, pullback happens, it touches the trend line, buyers step in and a new impulsive move begins. It's clean, it's powerful, and yes, the same logic applies to a downtrend. Just draw the trend line across the lower highs and you'll see how price respects it again and again. Quick note before we continue. If you're not sure how to draw trend lines correctly, don't worry. I've got a full video on my channel that breaks it down step by step. Just finish this video first, then go check that one out. So far, we've seen two types of trending markets, one based on horizontal support and resistance, another based on trend lines. But those are what we call static levels. They don't move, they stay fixed at a price level until broken or respected again. Now let's move to something different. Let's talk about dynamic levels, levels that move with price. This brings us to the moving average based trending market. Unlike fixed resistance or trendline levels, moving averages adapt and update with every new candle. They're like a moving roadmap that shows you where buyers or sellers are stepping in at the current moment, not just at historical levels. And when used correctly, moving averages act like dynamic support and resistance zones in trending markets. In this strategy, we'll use two simple but powerful tools, the 8-period simple moving average and the 21-period simple moving average. Together, they help you understand trend momentum, pullbacks, and entry timing. Let's say the market is trending up. You plot the 8 SMA and the 21 SMA on your chart. You'll notice something interesting. The 8 SMA stays closer to price. The 21 SMA trails just below it, forming a dynamic support zone. During pullbacks, price often returns to touch or slightly dip below one of these moving averages, especially the 21 SMA, before bouncing back up and continuing the trend. Here's what you look for. Market is making higher highs and higher lows. Price pulls back into the area between the 8 and 21 SMAs. It rejects that zone and starts moving up again. That's your signal, the end of the pullback and the start of the next impulsive move. In a downtrend, the concept is reversed. The 8 SMA is below price, hugging the short-term move. The 21 SMA is above, forming a dynamic resistance zone. Here's what happens. Price makes lower lows and lower highs. Pullback happens. Price climbs back into the 8 and 21 SMA zone. It gets rejected and the next bearish impulsive move begins. That's where you consider a sell entry. Now that you know how to identify an uptrend, a downtrend, and how to follow the trend by entering at the end of pullbacks, let's go one level deeper. Let's talk about how to predict when a trend is likely to end. In an uptrend, the market creates higher highs and higher lows. That's a healthy structure. It tells us that buyers are in control. Each new high shows strong buying pressure, and each higher low confirms that buyers are still defending the market. But here's where things get interesting. If the market fails to make a new higher high, that's the first warning sign. It tells us buyers might be running out of steam. And when the market starts showing signs of struggle at the highs, that's when you need to stop blindly buying and start preparing for a possible reversal. Let's look at this chart together. You can see the market is in a strong uptrend, making higher highs and higher lows. But then right here, something changes. The market tries to push higher, but it fails to break above the previous high. Instead, it forms a double top. What's the psychology here? The first top is a natural high where buyers took profit. The market pulls back, no problem, it's normal. But when price returns to the same level and fails again, that's when we know something's wrong. It means buyers tried twice to break through and sellers defended the level both times. That's a big shift in momentum. When do we confirm the end of the uptrend? It's not confirmed just because we see the double top. We confirm it when the market breaks the neckline, which is the low between the two tops. Once price breaks below the neckline, that's our confirmation. The uptrend is likely over. Buyers are no longer in control. You should stop thinking in terms of buying opportunities. Let's be clear though, this does not automatically mean a downtrend has started. We are simply recognizing that the uptrend is no longer valid and momentum has shifted. This helps you adapt your strategy, protect your capital, and prepare for the next move. Let's look at another example. This time during a downtrend. The market is forming lower lows and lower highs, which tells us sellers are in control. But here we notice something unusual. The market fails to make a new lower low. Instead, it forms a double bottom. A mirror image of the pattern we just saw. So, let's cover the psychology behind it. The first bottom is normal. Sellers push price down, buyers stay passive. The market pulls back, then tries to go lower again, but this time buyers defend the same level. And price fails to break lower. That's a sign that sellers are losing control. So, when do we confirm the downtrend is likely over? When price breaks above the neckline. The high between the two bottoms. Once that level is broken, you should no longer think of the market as a strong downtrend. The structure is broken, the momentum is shifted, and no, that doesn't mean an uptrend has officially started, but it does mean the downtrend has likely ended and you should stop selling blindly. So far, we've talked about the double top and double bottom, simple but powerful patterns to signal a trend might be ending. But those aren't the only ones. There are 3 more major chart patterns that can help you spot a trend reversal early, before most traders even realize what's happening. Let's go through them one by one. Triple tops. Think of this as the upgraded version of the double top. The market tries to break the same resistance level 3 times. Each time, sellers reject the price at the same level. This shows buyers are completely exhausted. Once price breaks the neckline, the uptrend is likely over. Triple bottom, same concept, reversed. Price tests the same support level 3 times and fails to break it. Once it breaks the neckline to the upside, the downtrend is likely done. These patterns show us that the market is trying and failing multiple times, which increases the probability of a reversal. Head and shoulders pattern. This is one of the most famous reversal patterns in technical analysis. It usually forms at the top of an uptrend. And here's how it works. The market makes a higher high, the head, between 2 lower highs, the shoulders. The neckline forms at the base of the pattern, connecting the 2 pullback lows. Once price breaks below the neckline, it confirms that buyers are no longer in control. Let's cover the psychology behind this pattern. The left shoulder is a normal push. The head shows strong buying interest, but when the right shoulder forms, buyers are weaker. Once the neckline breaks, it's done. Buyers give up and sellers take over. Now let's flip it. This pattern appears at the bottom of a downtrend and it often signals a bullish reversal. It is called the inverse head and shoulders. The market forms a low, a lower low, and then a higher low. This shapes the left shoulder, the head, and the right shoulder. When price breaks above the neckline, the downtrend is likely over. Let's cover the psychology behind this pattern. Sellers tried to push the market lower again and again, but on the third attempt, buyers held the level higher, showing strength. Breaking the neckline is the final signal that momentum has shifted. We've seen how the market behaves in a trend, whether it's going up or down. But what if the market isn't trending at all? What if price is just moving sideways, stuck between two levels? That's what we call a range-bound market, or simply a range. So what is a range-bound market? In a range, price moves back and forth between a well-defined support and resistance level. The market doesn't make higher highs or lower lows. Instead, it creates equal highs and equal lows, bouncing between them like a ping-pong ball. At the bottom of the range, buyers step in. At the top of the range, sellers take control. So what's the psychology behind it? A range-bound market represents a balance between buyers and sellers. Neither side has enough strength to push price into a new trend. This usually happens when traders are waiting for news, the market is accumulating orders, institutions are building positions in silence. To most retail traders, a range looks boring, but to smart traders, it's an opportunity. There are two trade setups that most traders watch for when trading range-bound markets. Let's look at the first setup, a rejection from the support level. As you can see here, the market is ranging. The price respects a well-defined support and resistance zone. Suddenly, price dips below support, just enough to trigger stop losses from early buyers. This quick move below support is what we call a liquidity sweep. It's not a breakdown, it's a trap. And then watch what happens. Price reverses immediately, closing with a bullish candle back inside the range. This candle tells you everything. Smart money just cleaned out retail liquidity and is now pushing the price back up. Here's how to trade it. Entry at the close of the rejection candle. Stop loss just below the wick under the support zone. Target the next resistance level. As you can see, price pushes upward from support and eventually hits the resistance level. Your target is reached and you're out of the trade, while others are still confused, waiting for confirmation. This is how professionals trade ranges. Now let's flip the setup and look at a rejection from resistance. Again, the market is stuck in a range. This time, price pushes above resistance, triggering breakout entries from retail traders. But instead of continuing up, price gets rejected aggressively and closes back inside the range. What does that tell us? This was another liquidity trap. Smart money used that breakout to sell at a premium, just before reversing the move. Here's how you trade this rejection. Entry at the close of the bearish rejection candle. Stop loss just above the wick over the resistance zone. Target the next support level. You're simply playing the edges of the range, using liquidity traps to your advantage. Let's look at the second setup, the pullback after a breakout, starting with a breakout above resistance. In this case, the market was ranging, just like before, bouncing between support and resistance. Then it happens. Price breaks above resistance, and this time, it doesn't come back immediately. It closes strongly above the range. This is not a fake out, it's a genuine breakout, and the smart move here is not to chase it. You wait. A few candles later, price pulls back, right into the previous resistance zone. Now watch what happens. Instead of falling back inside the range, price respects the old resistance as new support and prints a bullish rejection candle. This is your confirmation. Here's how you trade it. Entry at the close of the bullish rejection candle after the pullback. Stop loss just below the support zone, form a resistance. Target, aim for the next significant resistance above the range. You're not chasing momentum, you're joining the trend after smart money confirms the breakout with a clean retest. That's how you trade the breakout pullback strategy like a pro. Now let's flip the setup and look at a breakout below support. Same idea, the market is trapped in a range, bouncing between two levels, then price breaks below support with strong momentum. Don't rush in. Instead, you wait for the pullback, and here it comes. Price climbs back up and retests the broken support. This is a key moment. If this was a true breakout, the old support should now act as resistance. And that's exactly what happens. Price rejects the level with a bearish candle and continues downward. Here's your trade plan. Entry at the close of the bearish rejection candle. Stop loss just above the new resistance old support. Target the next key support level below the range. Once again, you're not trading the breakout itself, you're waiting for confirmation and positioning with smart money after the market shows its hand. If you found this video helpful, please give it a like, subscribe to the channel, and don't forget to hit the notification bell so you never miss a strategy that could level up your trading. Thanks for watching, and I'll see you in the next one.